to DD Talk's Commercial Real Estate Finance and Restructuring Seminar. My name is Jeffrey Rubinoff, and I'm a partner at international law firm White & Case, specializing in real estate debt situations. We've got an excellent group of panelists for you this morning, as you will have seen on the intro slides, all of whom are market participants with extensive experience in the sector. There is very little housekeeping required for this session. No need to remind you of where the exits are, but I should say that viewers will be able to submit questions by using the Q&A bar at the bottom of your screen, and we'll try to pick up any questions as we go, or perhaps at the end, depending on how the technology works. In terms of our agenda for the hour we have been allocated, I will say a few words by way of introduction, then I will ask the panelists to introduce themselves. As I'm unable to refer to people being to my right or my left, I have asked the panelists to introduce themselves in alphabetic order, finishing with Carlo Savani, who will also provide us with a brief presentation by way of scene setting. We'll address the various topics identified in DD Talk's outline for the webinar, as well as a couple of others, by grouping them into three sections: the distress landscape, dealing with distress, and then, being the optimistic sort, we'll complete the discussion on a more upbeat tone, looking at new origination issues and other market developments. As noted, we'll finish with any questions from the viewers. I think the distress we will see in the real estate sector will be situation specific, although no doubt trends can be identified, and Carlo will say more about these. At a macro level, yesterday's FT article on the COVID rent debt challenge by business columnist Helen Thomas was timely. In it, she refers, among other things, to Schrodinger's tenants, businesses that may or may not have survived the pandemic, but remain in occupation. As we emerge from the world of furloughs and moratoria on evictions, the true state of the income position of landlords, also known as borrowers, will start to become more clear. At an even more macro level, the comment earlier this week from US Treasury Secretary Janet Yellen that interest rates may need to rise so that the economy doesn't overheat, although not entirely surprising, does seem to suggest that if world economies don't recover quickly from the pandemic, that will be bad. But if world economies do bounce back too quickly, that will also be bad, but for different reasons. I appreciate I have grossly oversimplified, but I think it is fair to say that there is at least enough of a risk of turbulence ahead that spending a bit of time considering the subject of distress won't be a waste of anyone's morning. With that, please may I ask Gregor Bamert to lead us off with the introductions.
Thanks, Jeffrey, and thanks for the opportunity to be part of the conversation. My name is Gregor Bamert. I look after the real estate debt business at Aviva Investors. We have a just over £8 billion portfolio of predominantly senior commercial real estate debt across the UK and Europe. I'll hand over to Adam next.
Thank you, Gregor. Yeah, just to echo your sentiment, great to be here today and taking part. I'm Adam Callaghan. I head up Greystar's project finance and legal team in Europe. For anyone who hasn't come across Greystar, we are one of the largest and most experienced rental housing investors, operators and developers globally, operating in excess of $200 billion of real estate across the world. Our roots stem from the US, but we've been operating in Europe since 2013 and spanning 7 territories now. As I said, great to be here, and hand over to Alex Lanni.
Morning, everyone. Very nice to see you. I lead the credit strategies team at CBRE Global Investors. I lead up the investments part of that, and that really is focused on everything from lending money at the outset to ensuring that we get it back. That's a very important bit. We are primarily focused on a whole loan strategy, whole loan and special situations, and we're managing an existing book of just about 1.5 billion euros, and looking forward to there being lots of new opportunities post this distress. I'll hand over to Alexander.
Hello, my name is Alexander Oswatitsch. I am responsible for the real estate debt fund business at EWS. So we're part of the alternatives asset management business of EWS. We manage institutional money of institutional clients, investing in commercial real estate debt across Europe. We have a pan-European approach. with a team like across Europe, and we manage currently about 2 billion euros in EUMs across different strategies, from the senior side to the junior side. And with this, I would hand over to Carlo.
Thank you, Alexander. Thank you, everyone, for being here, and thank you to DD Talks for inviting me as one of the panelists. My name is Carlo Savani. I'm a director at Alantra. We are I will talk about Alantra more details afterwards, but basically we are a pan-European investment bank based out of Spain. And I am leading the international real estate advisory proposition, where we focus on real estate portfolio, M&A advisory transactions, real estate financing and debt. And our core markets, I would say, are mostly Portugal, Spain, the UK, Ireland, Greece, and Italy at the moment. Thank you everyone again for being here. Back to you, Jeffrey.
Thank you very much. So I think we're ready for the presentation. So if the slides can be put up on the screen, then Carlo, I'm back over to you.
So I would like to grab a few minutes for today's DD Talk session to discuss about real estate risk. Risk in real estate has changed significantly because of COVID and because of the structural changes across different real estate sectors over time. So I would like to touch base on what real estate risk was before the pandemic, how the markets perceived it, and how is that changing now because of the short-term lockdown measures imposed by the pandemic, but also the long-term structural features. Before doing that, though, I would like to give you a brief presentation on Alantra and our division, just for context and to introduce the rest of the topics. Alantra, as I mentioned before, is an investment bank based in Madrid. We have 3 legs, one of them being asset management, with basically over 12 billion between funds of funds and direct investments. We have investment banking division, where we do classic debt advisory, M&A, and equity capital markets and debt capital market transactions, more focused on the corporate side. And then we have credit portfolio advisory, which is basically the division that I belong to, where we advise on credit and real estate transactions, as well as structured finance across Europe and in other locations globally. Next slide, please, Natalie. In doing a deep dive and focus on real estate, which is the broader topic for discussion today, we at Alantra provide advisory in respect of real estate portfolio transactions, traditionally more on the REO side, meaning distressed or opportunistic real estate portfolios resulting from repossession of NPL loans with the wave that occurred in Europe over the past few years. We also advise on funding and joint ventures in respect of real estate developments, for example, but also mezzanine financing for companies in the real estate sector. We also advise on restructuring and placements. We were recently involved, for example, in the structuring of a REIT in Portugal with a new law there that enables these vehicles, relatively recent when compared to other European markets. And we also advise on single asset sales, particularly more with a focus on complex assets that require more of our intervention. Next slide, please, Natalie. In terms of our team, as I mentioned before, we are present throughout Europe. At the moment, our core markets are Iberia, Italy, the UK, Ireland, and Greece, but we're also expanding into Benelux, Germany, and DACH more broadly. We also have more of a global presence with offices in Shanghai and in Sao Paulo in Brazil. That is for the brief presentation of Alantra. So let's now go directly to the main topic for discussion today, which is the real estate risk. So if we look at how the markets perceive real estate risk before the pandemic, and taking as a reference the US market, which is the most liquid market in terms of real estate and the most securitized market in respect of real estate, where a lot of companies are simply listed and trading, and where you have a very specific REITs who dedicate to an individual asset class. we can observe two major factors. One of them being on the left side of this page, basically how the market perceived risk in terms of correlation or betas, in this case, unlevered betas. And what jumps to the eye here is that REITs, when compared to real estate development companies, real estate general companies, or real estate operations and service providers, were of a significantly lower risk on an unlevered basis. In fact, we can see that REITs were more perceived as a stable cash flow and income producing vehicle, which had less market correlation and was more defensive, generally speaking. Obviously, then when we go into the potential or the capability for each of these companies on average to lever themselves up, we see that REITs effectively were one of the most levered when compared to real estate developers or the other type of industry segment participants. And this is what effectively made some REITs more risky, as the leverage was ultimately a means to enhance returns given yield compression across all real estate sectors during the last few years before the pandemic. So effectively, the main conclusion to draw here is that property holding and stable cash flow producing assets were perceived as lower risk by the market. But then if we delve more deeply into the sub-asset classes, and we classified risk, each REIT in the US according to the underlying real estate sector to which they were exposed, we can see that there is a very large and significant digression. If we look, for example, at sectors such as healthcare and residential, they were typically considered more conservative and defensive plays insofar as they were less risky than the broader market. Whereas at the other end, you had the hotel sector, which because of structural features around operating contracts no longer being based on fixed rent payments for the hotel industry, meant that they were perceived as more risky by the market, also being termed as more cyclical. It's interesting to note how sectors such as industrial were particularly risky before the pandemic, but now with the advent of e-commerce and the growth of logistics, that sector has been experiencing a boom and a strong yield compression and lots of investor demand. So industrial before the crisis and industrial post the crisis, particularly when we look at more the logistics assets, is a completely different story. Similar case to, I would say, retail, which before the crisis was relatively in the mid-range when compared to the other asset classes. But now, as we all know, it's being greatly challenged, not only by the short-term lockdown measures of the pandemic, but also by the long-term structural features of shift to online purchases. Next slide, please, Natalie. So then let's look at what COVID has done and where is risk being perceived across these asset classes. We should classify first, in reference to the graph in this page, assets between macro trend assets and cyclical assets. Macro trend assets are those that have an underlying growth in demand and momentum, even carving out specific niche sectors, and thus are less exposed to the cyclicality of the economy. Where cyclical assets are the ones that tend to rebound the most, but also to fall the most when you consider the cycles in the broader economy. Then, when we look at other factors specific to COVID, we need to consider what was the long and short-term impact of COVID. So the pandemic imposed a series of lockdown measures, which created, for example, a situation for some assets like care homes and student accommodation, but also co-working, which were considered micro trend assets to a certain extent, but were heavily impacted by short-term measures around the sector. However, we believe that these sectors will recover rapidly and strongly from the pandemic as soon as the lockdown measures start to ease across different geographies. If we look instead at the lower left quadrant, those are the most defensive sectors, sectors that have even boomed or performed better during and after the pandemic than before. Crucially, urban logistics or last mile logistics, sanitary buildings and facilities, non-discretional retail, meaning convenience retail, private rented sector, residential, and data centers amongst them. So those are the sectors that are less cyclical and least exposed to COVID, even having an upside to them. We look at the other extreme, to the top right sector, we see hotels which are cyclical and that have been most exposed to COVID, both in the short, but maybe also in the long term. Particularly discretionary retail is over there because, as I mentioned before, the shift to e-commerce, but also the short-term lockdowns imposed by the pandemic. And hotels, particularly in the business travel segment, which are also likely to face some long-term challenges as the widespread adoption of video conferencing technologies will probably dent demand for business travel. Others in that category, in our views, include parkings, but also residential development to a certain extent. Then we look at the cyclical assets, which have not been impacted that strongly by COVID, but have traditionally been more cyclical than the rest. And that includes traditional offices, industrial and logistics. Traditional offices probably being closer to the high-risk segment on the top right than certainly industrial and logistics, traditional logistics effectively being in the midst of a rebound. So what this picture effectively tells us is, where do we see the combination of short and long-term specific impact of the pandemic on different asset classes when considered in the backdrop of their cyclical nature in the context of the broader economy? Next slide, please, Natalie. If we take a look at a recent survey that was performed throughout LP investors across the globe, we see that the effects of the pandemic are also influencing their investment decisions in terms of strategy, but also in terms of appetite by sector. What jumps to the eye from the top left pie chart is that effectively investors are considering three main investment strategies at the moment, or at least that is their preference. And that includes opportunistic and value add, because of the dislocation brought by the pandemic to some asset classes, as we commented before, but also credit being an emerging asset class and a growing one, particularly in Europe. In the US, it was existing far more widespread long ago, as banks have retreated from financing the riskiest types of positions, and there is more and more space from non-bank lenders and credit funds to enter this segment. If we look at the sector, it's quite obvious that between residential and logistics, you have more than half of the entire appetite and demand across investors. Look at particularly on the opposite office segment, only at 2% in terms of most preferred asset class in terms of investment. We should note that offices currently represent a very large portfolio of existing assets under management for most investors out there. And it's striking to see that almost none of them listed offices as their preferred asset class at the moment. Now, obviously, this is a global assessment. If you look at specific underlying markets, for example, like Germany, the office sector there is performing still quite well. I'm not going to go probably too much into detail on the strategies by sector that each of these investors relayed to us, but effectively, what is important to understand is that investors are still prepared to invest in the most distressed asset classes at the moment, but it's a matter of finding the right strategies. So, for example, in the retail segment, where most investors are shying away from, you can still find pockets of liquidity when focusing on convenience retail and focusing on retail business models, which are leaning more towards click and collect or curbside services, as well as dark stores distributions within cities. Whereas they're more skeptical around your mid-range secondary malls in non-major cities. In the office sector, there's a similar story to that. Good proximity to retail and leisure and residential assets, cities with a young and emerging workforce are still favored. Logistics is a very, very hot asset class, just as housing, but there are segments within both that command a premium, such as last mile delivery for logistics, or in terms of housing, the growth of private rented sector in Southern Europe, the emergence of co-living and branded residences across most geographies. And then in terms of alternatives, which are gaining more and more in terms of popularity, we see cold storage, dark kitchens, life sciences facilities, and healthcare facilities more in general as very interesting asset classes, along with data centers, of course, where investors have a strong preference for. Next slide, please, Natalie. just to finish, I would like to do a deep dive, particularly on major considerations around tourism-related assets. As you know, we are Alantra is a Spanish-based company, and we're very much close to what is happening in the tourism sector here, being such an important part of the Spanish and Portuguese economy as well. According to the predictions from the World Tourism Organizations in this front, tourism will recover to pre-pandemic levels only by 2024. That is 3 years away. This is a global projection, of course. We are more optimistic in respect of Europe because there is a lot of intra-European travel that will recover faster and more immediately, whereas most faraway locations in Southeast Asia, or perhaps even the Caribbean, will take probably longer to recover. But what this tells you is effectively that, according to these predictions, the tourism industry still has a bumpy ride ahead for at least another couple of years. If we deep dive into the two major segments, which is leisure and business travel, we think that leisure is going to recover very strongly from this crisis, and it will continue, and there will continue to be a lot of investments and demand. Whereas business travel is a bit of a question mark at the moment, as I mentioned before, because of the emergence of new technologies around video conferencing and communications. It is very much likely that the business segment for travel is probably going to suffer a little bit in the long term. That said, with regards to the presentations, please, if you have any comments from the panelists or questions from anyone in the audience, happy to chat through.
Carlo, thank you very much for that very interesting presentation. Something that's absolutely clear from listening to that presentation is, as many of us I'm sure already know, the real estate market is not homogeneous, both by jurisdiction and by sector, and by investor appetite for strategy. It's a very complex ecosystem. By contrast, the approach, at least to the UK government, of trying to protect tenants from eviction has been uniform, and didn't really take into account the various positions of different tenants in different circumstances, but has applied across the board. Now, again, timely for this session this week, the government has completed its consultation with industry representatives as to how we get ourselves out of this position where rent has not been collected in the normal way, and the ability of landlords to address that absence of cash-paying tenants hasn't been able to be dealt with in the usual way. Perhaps I can ask Alex to comment from her perspective on this disruption in rent collection and what we might be looking forward to in the coming weeks and months.
Sure, Jeffrey. I think it'll come as no surprise to most, and particularly echoing some of the fluctuations or the more distressed sectors that Carlo mentioned in his presentation. I think we've seen most disruption to hospitality-led and retail-led sectors. I think Remit Consulting produced some stats around collection rates after sort of 21 days after kind of the standard collection quarter dates. And I think for all property back in June of 20, I think the average collection rate was around 60%. Which as at March 21 is at 67. But interestingly, that is a cutoff of 21 days after collection, and actually if you fast forward to 90 days post collection, actually that 67% looks more like 80%. And as I said, the two sort of key sectors that are holding that back a bit are in relation to retail and hospitality. If you look quarter on quarter, and certainly something that we experienced, I suppose, in our own book, quarter on quarter, the September quarter was definitely better than the previous two that had gone before. And I think that there's clearly a direct correlation between those retailers or hoteliers or restaurateurs' ability to collect cash from being open and being allowed to trade as distinct from not. I think that the ways in which we approached dealing with rent collection issues right at the outset of the pandemic really were to try to take a view that if this continues for a year, can we structure loan facilities with perhaps some injection from borrowers, or perhaps some injection from us, or an injection from CBIL style government provided facilities to tenants, to ensure that there is interest serviceability throughout that 12-month period. I think initially there's a little bit of resistance to, gosh, do we really need to look as long as 12 months? And sure enough, it has played out that 12 months has been necessary. I would say that by and large, obviously we sit in a whole loan position, which generally means loan to values of 65 or 70%, which means the debt quantum is a little bit higher than on senior positions. But we have had sort of full interest collection across our book, and we found that borrowers and tenants, you know, have tried as hard as possible to avail themselves of government support, or indeed looked, you know, to their own reserves to help ensure the stability of the loan position during the pandemic. I think this final quarter in March, in terms of rental collection, has taken a few people by surprise, because I think that everyone was really hoping that people would be available, you know, would be allowed to trade for this first quarter of the year, and that's not happened. So I think where you know, some tenants had sought CBIL style support, it's slightly starting to run out. So I think that people really do need to get back in trading to help with the collection picture going forward.
Alex, even when cash starts to flow through again, I suppose depending on how financial covenants are drafted into the facility agreements, there might still be a period of time where actual compliance with covenants is still going to be a challenge for borrowers. From the way you've described it, your focus has very much been in trying to work with your borrowers to deal with the cash flow situation. And you know, strict covenant compliance seems to be a second order point. Do you think that will continue for a period, or are lenders kind of coming to the end of their patience?
I think there's probably a mix across the market, Jeffrey. I think that, and I think it's a little bit sector specific as well. There's a kind of not necessarily there's no size fits all. I think that we've certainly been focused on there being a balance of measures, in that if a borrower is looking for some relief in relation to covenants and so on, we're looking for that to be a bit of a partnership. If there is cash which is put on deposit to show that we will be interest serviced for the next 9 months, yes, we've looked favourably on providing some element of covenant compliance, forbearance or relief in that context. I think that it's slightly different for where there are sectors of structural change. So I think where, you know, I know certainly there's been a bit more holding borrowers' feet to the fire in relation to some shopping centres, and we've seen some NPL portfolios come to market and so on. I think the interesting one which will start to play out is around hospitality. I think that, you know, also from what Carlo's saying there are some likely structural changes to the way in which people are travelling, particularly for corporate purposes. So perhaps there comes to a point where lenders are a little bit more focused on, well, what really does forward-looking covenant compliance look like, as it takes a longer period of time for things to regularise themselves back to pre-pandemic levels. I think on covenanting as well, we've looked at, you know, I suppose payment plans that borrowers have agreed with their underlying tenants, and tried to come up with a, you know, a kind of almost like a hybrid covenanting scenario, which is, rather than taking a more draconian view of their 90 days past due and you can't include that, you know, where there has been proactive agreement of payment plans, which effectively is, you know, short-term changing the profile of the original lease. We've sought to try to amend things to help tailor covenants to those types of plans.
Thank you. And perhaps I'll just take, we've had a few questions come in. One that might get covered later on, but as it's come in now, and I'll just throw it out to the panel now. And it relates in part, and this is why I raise it now, to covenant compliance. But one of the questions that's come in is around whether we are seeing in the market liquidity coming in at the, what I would call the holdco level, where sponsors who have current issues with their cash flow and might have issues with covenant compliance are seeking liquidity from lenders who would come in at a higher level up in the capital structure, or a lower level in the leverage structure behind existing lenders, in order to help a sponsor manage their relationship with their senior lender. I don't know if any, in the context of the distress that you're seeing in the discussions you're having, are borrowers coming to you and say, yes, we've got someone out there who's looking to give us an investment that we can then deploy from a liquidity perspective to help meet our ongoing obligations to you as senior lender?
We've been fortunate enough not to have such a level of distress that's been required across our book, but I guess across the market I have heard of those circumstances. I think that, and it is particularly with reference, I think, to this first quarter of the year. I think a lot of borrowers or owners of particularly operational assets had thought that they could get themselves within their own resources through to the end of this year. But I think as they've sought to ensure that they're prepared for senior lenders perhaps not being quite as accommodative on an ongoing basis, they have sought almost like standby facilities, or perhaps capital injections, both at equity level and at sort of maybe pref equity level, to help to ensure that they can keep their senior stack stable. So I have seen a little bit of that, but not on a very, very wholesale basis, I would say.
Yeah, I would agree here with Alex. Is like, we've started to see that, like, in a few cases on hospitality financings, but obviously with such situations, it's almost kind of like your quasi equity thing, because it for the existing lenders it needs to be deeply subordinated, right? Because whether you have like a senior or whole loan or like a senior mezz structure, right? Whoever comes in, it's almost like a shareholder loan financing the funding gap. But obviously not like in addition to the capital.
Understood. Thank you. I think this takes us on to the next item in the context of the current situation, which has to do with the challenges that we'll be faced with when the existing policies run their course. Appreciating that in relation to the moratorium in evictions, how they're going to run their course is still the subject of discussion, possibly also in relation to furlough. We'll come back to that. But Gregor, if I can ask you to comment on that. One question that's come in relation to this point is asking for the panel's view on the risk of zombie companies once government support is lifted, which I think is pertinent to this particular subject. So Gregor, if I can ask you to comment.
No, thanks, Jeffrey. And I think in many ways this is kind of the key question going forward, because as Alex has already touched on, there's been a moment of crisis. The question is really how does the recovery happen from now? And the recovery can be bumpy, right? In past crises, what we've seen is corporate insolvencies actually peak during the early phase of a recovery. And that tends to be for two reasons. Firstly, it's about there is just a time lag effect, right? So, kind of the financial impact of a crisis takes a while to make its way through corporate balance sheets. But then the second piece is recovery needs investment. We've touched on, some of the leisure and hospitality. Well, if you've closed a hotel for a number of months, getting it back up and running needs a cash flow injection. There needs to be money there. And if you have people who've already had to, kind of tied over for months on end, that becomes challenging. And, you touched on in your introduction, the reference to the Schrodinger's tenants, where, are they alive or are they not? Because they can't be both. I think the the added complexity is the cat in Schrodinger's example here has an incentive to be perceived as dead when maybe is still alive, right? And so using that as a way of, maybe not fully fulfilling their financial obligations. So that is a really important part. But the other piece about the recovery is, and both Carlo and Alex touched on this, is those situations where actually the pandemic has just accelerated structural change. So actually what's happened is certain assets were probably already on a declining trajectory. Certain companies might have been on a declining trajectory, and this has just accelerated it. And that in many ways actually creates really interesting opportunities. We've seen a number of cases, across Europe and UK where, old department stores have been completely repurposed for other areas. There is investment there, there's new jobs being created around that, but that clearly is only the case in some. And so that during that phase, we will definitely see a much wider range of outcomes at an individual asset level.
Excellent. Thank you very much. Adam, can I just ask you on a related point? You're obviously, as a business, reliant on the people who rent from you paying their rent. And I don't have a feel myself for how many of those occupants are relying on furlough schemes in order to continue to pay the bills. Is Greystar concerned at all about what will be the fallout once the furlough scheme ends in terms of the ability of your tenants to continue to pay their rent?
So I think, on rent collection, it kind of goes back to Carlo's presentation. I think PRS residential has kind of come through the pandemic as one of the most resilient sectors. And there's probably, from our perspective, 3 reasons for that. The first is, frankly, the great work our on-site teams do in terms of engaging with tenants, managing situations, offering deferrals, early move-outs where necessary. The second is, as you've said, the government intervention and the stability that the furlough scheme has brought. And the third is just the underlying, stability of the asset class itself. So I think from a collections perspective, it's probably less of a concern. And obviously, the nature of these tenancies are that they're relatively short-lived. They're usually 12 months, etc. I think the more immediate challenge in our sector has been occupancy. So obviously, a large proportion of our residents will be young and have other places they can move to in times where there is financial distress. But I think rent collection for us hasn't been as great a challenge as it has for other sectors of the economy.
I'm delighted to hear it, as I assume will many of the investors in that sector looking at that particular strategy. So varying views as to how the government support withdrawal will impact on the market, the opening of business back up after lockdown, tolerance from lenders. With all that, there will still be, as Gregor identified, some sectors which just aren't going to come back, or indeed some individual situations which aren't capable of being recovered, at least not without quite a bit of effort from all the participants involved. So moving from the possibility of distress to dealing with actual distress, Alexandra, I was wondering if you could comment a bit about where things are from your perspective in terms of borrowers who frankly aren't able to manage their existing situation, requiring you to start taking a more active role in solving their problems.
No, sure. And, I think obviously kind of like the way the industry has dealt with the situation, like Alex touched quite a couple of important points. I think we are kind of like in different levels of that discussions. Sometimes we're in the senior, sometimes in the B note, sometimes in the mezz loan. Obviously, the big theme was a bit kind of like a cooperative approach, right? Depending on like how your view is on the value and compared like to the cash flow gap, or lenders have taken like on certain covenant covenant triggers like a more cooperative approach. But obviously that being said, there, especially like on the hospitality side, there were like situations where portfolios or loans like were running actually really quickly in the first lockdown into troubles, and actually like we have been dealing with a portfolio of UK-based hotels with a proper opco structure, like where the opco was actually running into insolvency, like without sponsor support in the first lockdown. And the sponsor gave back the keys, and then like this really like went into a quick restructuring, including hiring a restructuring advisor. And at the end of the day, like the involved lenders, being like the super senior, the B note, and the mess lender, like to a certain extent working together, and the mess like taking the equity position at the end. And like on this one, like it's you have like quite a complex setup, right? With 3 different layers in the capital involved. You have basically really like with the ICA issues, intercreditor issues between senior and mess, and then between like your super senior and senior. And I think takeaway was like, one thing is like the legal side. One thing is kind of like everyone like needs to take a view on the value of the assets, and like how you are covered and how you can protect your own position. But then on the other side, it's really a lot about kind of like discussions and interactions between like the different financing partners, and especially like in these cases where you have like an insolvency situation on the not on the propco but quickly on the opco, which is involved. It's sometimes an issue that, especially like with large senior clubs, with syndicated senior clubs, the decisions take time. And to kind of like bring this under like a coordinated timeline with like a pressure of like a restructuring situation, where like on the one side, like the mess is looking into like how can they protect their the most vulnerable position, possibly raising some funds from the investors to take over the equity position, versus then like on the other side you have like a large senior consortium which is trying to come like to a majority decision between like 5-6 different parties, which might be not only in Europe but like even like with some Asian lenders involved. That's quite a complex undertaking.
Thank you. On that subject of it being a complex undertaking to work through a distress scenario, and asking what might be a slightly provocative question, I recognize that Alex had previously said in introducing herself that her area of responsibility stretches from giving the money out to getting the money back, which is a very sensible whole life analysis of a credit position. But with the increasing numbers of participants in the credit space, some of whom may just be building their teams up and may be focusing or have been focusing on underwriting, do we think there are enough skill sets out there amongst all the people who have been giving money away or sending it out, not giving it away, to have the skills necessary to actually work through distress and solve these situations in order to get the money back? Or are we, at risk of having some market participants that just don't really have what it's going to take in order to work through these situations? So I'm not going to necessarily direct that at anyone, but I can't pick on people if you like.
Sorry, Gregor, carry on.
I was going to say a slightly controversial question. I would say, look, there's plenty of capital available for these situations that need recapitalization, and there's plenty of experience and skill. The last crisis wasn't that long ago, and I think a lot of people have sort of been through that. I think you're right to challenge. It may not be that all of the skill and all of the experience is in the same place.
I think I would definitely echo that the capital structure that we have now as compared to when we went through the global financial crisis is so different that it feels like there is, particularly in the credit space, a much more stratified market. That means that where there might be a call for pref equity or higher leverage mezz or whatever, I think that there are a number of different providers of that capital now in a way that they didn't necessarily exist, or they weren't as readily formed following the financial crisis. And in terms of expertise, I think it's really interesting actually to look at, we're sort of a year on following the original onset of COVID, and actually how the credit market has dealt with the crisis by comparison to how it dealt with the global financial crisis. I think that a lot of borrower, I think, as Gregor says, 10 years ago or so isn't that long ago for people to remember it. And I think that whilst there has been forbearance from lenders, which has been sort of centrally encouraged, if you like, to happen, I think borrowers have also been very mindful that they, some people weren't quite as accommodating 10 years ago, and they don't want to find themselves in a situation where they're caught, a little bit like they were at that stage.
Carlo, just a related question. When that kind of centralized, incentivized forbearance starts to wane, and in fact, we might come through from a different direction, as we did post the financial crisis, of bank regulators seeking to have banks actually recognize their distressed situations and their non-performing loans and deal with them. Do you think that we are going to see more of lenders, rather than wading into the effort involved in resolving individual situations, seek to exit on a portfolio basis, either from certain jurisdictions or certain real estate sectors where we can all see, and recently and currently in the market, NatWest is in the process of trying to divest itself of a portfolio of loans related to retail. Are we thinking that we're going to see more of that as a solution, at least for that lender, in dealing with that part of its loan book? It doesn't provide a solution necessarily to the borrower, although it might, because of course sometimes those buyers of those loans are more able to deal with the resolution of the situation than perhaps the commercial bank was. But do you have a view on that part of the market?
Certainly. I think that what is different from the aftermath of the great financial crisis and the sovereign debt crisis in Europe that was a little bit later, what is different this time, it's 4 key factors. One, banks have since implemented IFRS 9, which means that you have to forward, bring to current value your forward provisioning of the likely future performance of the loans. That means you have to impair, and you have to impair more strictly than before. You don't have that much discretion in terms of considering a loan and assessing what is the likely impairment, at least from a lender perspective. Second, the ECB has overtaken supervision powers over nearly all of the large banks in the Eurozone, and the ECB is more neutral, less likely to be captured by vested industrial interests or a revolving door, let's say, influences that can be more accommodating towards certain national banks who have a strong political influence. Thirdly, some banks have already undergone a carve out of their servicing operation, particularly in Southern Europe, which means that banks lack in-house capabilities to manage large volumes of credit like they did before. Some of those carve outs entail the transfer of over 500, 600 employees to investors. And since then, they have not rebuilt those capabilities in-house. And fourthly, you have a situation in some markets like Spain, Italy, some might say even Germany in the future, where banking consolidation is required. Otherwise, the industry profitability is just terribly low and underperforming. In order to consolidate, in order to acquire, in order to merge, you need to clean up your balance sheet. So what we do think is that lenders will be under a much more accelerated pressure to try to dispose and divest these assets because they don't have the capabilities. They might need to consolidate and need to clean up their balance sheet faster. They have a regulator, which this time is putting a lot of pressure on them, and they have very strict accounting rules that force them to do so. On the other hand, however, we need to create a distinction between granular credit and large positions. Banks certainly don't have the capabilities to manage granular credit. So we might see a lot of secured non-performing loan portfolios of smaller granular credits come into market because banks will not have the in-house capabilities to manage those. When it comes to large positions, large corporate positions, particularly on the real estate sector, it can be a different story because there the banks still maintain a lot of expertise in-house, also non-bank lenders, and sometimes the effort and time that is dedicated to helping a borrower turn around their situation by providing fresh capital or third-party equity financing is the same effort for a relatively large borrower than a smaller one, thereabouts. The problem you have is that obviously you need to classify your priorities and dedicate most of your attention as a lender to the large positions, whereas the smaller ones, you probably sell them to an opportunistic credit fund that would buy the portfolio and then outsource the servicing to a servicing platform in each of these markets.
Thank you. Interesting insight into that part of the market. So, it's starting to sound like the situation, in post the global financial crisis, there was a lot of talk of wall of this and wall of that, and we're all going to be submerged under typhoons of problems. Based on this conversation anyway, it sounds like, yes, distress, but manageable. We can kind of see a way through the current situation. There are many tools, and as Gregor and Alex said, 10 years ago is not that far. People haven't forgot the tools that they used to resolve the situations that they were in last time. They've got different situations now. There's a lot of liquidity in the market. So let's take a moment, and I know we're coming up to the end of the hour, to turn our heads away from dealing with the existing situations that need to be resolved into a view of putting more money out into the market to take advantage of the liquidity of the appetite for investors to be investing in debt products. There was a question that came in early on. What is the example of the credit sector? And I think that had to do with Carlo in your presentation, looking at the different strategies, and one being credit, which I think, if I got the question right and possibly the answer, we're talking about the interest of people as an investment in investing in debt, and most of the people on this call are involved with those types of investors who deploy capital in their direction, who for them to then invest by lending it out. And I think that's what we mean by the credit sector. And an interesting point that we may get a chance to come to is whether that increase in the sector is driven in part by existing debt investors who want to turn their focus to real estate, or existing real estate equity investors who think, I'd like to move down the risk curve, stay in real estate, but deploy capital as debt rather than as equity. And we might get a chance to chat about that. But in terms of new loans, we had another question that came in, which was, how are new facility agreements on new lending adapting for experiences from the last 12 months? Are there new structural features in addition to just conservative underwriting? Which I think has an inbuilt assumption that underwriting has got more conservative. I suspect Adam hasn't necessarily experienced more conservative underwriting, and perhaps you can comment on that in a minute. But Alexandra, if I can turn to you, has your approach to underwriting new deals changed materially as a result of your experiences over the last 12 months?
Well, look, it's I think we tend to think that we are already before we applied like a conservative underwriting, right? Always kind of like looking at like what can go wrong as a lender, and kind of like looking at the downside case and like how we can get. Of course, you have adjusted kind of like your underwriting, the way you look at like hotels, and kind of like like it's the ramp up period, how will be like the impact over the next couple of years, right? But from a fundamental approach, I think neither like in terms of like how we approach a transaction or how we like structure the documentation, it has materially changed. Of course, like all your underwriting parameters, you account for this, right? You you adjust a little bit in terms of like sectors or subsectors, what you might be more focusing on. Retail is a good example. Like, so we rather like focus on supermarkets, food retail, the convenience store segment, and not so much like at what traditional was more kind of like the shopping center sector. But that's kind of like moving a little bit along like with the market and kind of like where our own research view sees like the trends and the opportunities going forward. That's obviously kind of like where you direct your efforts. You obviously might adjust in terms of kind of like your leverage. So I think in the more liquid asset classes, be it like logistics, residential, or kind of like more core CBD, good office, you're not going to have materially changed your leverage ratios. It's going to be different if you look at like a more traditional shopping center, like your hospitality situation. But I would say kind of like you continue with your prudent underwriting. You of course like adjust parameters you use for it, but are you going to really like approach it fundamentally different? That's
Thank you, Alex.
I think just one very quick thing to add. I think everyone's realized that cash is king in these types of circumstances, and I suppose the question is whether what's happened with this pandemic is something that you underwrite happening once in a 100-year period, or once in a 10-year period, or once in a 20-year period. But I think that particularly, I suppose for us, cash or interest deposits, or almost like a standby facility to allow this sort of short-term disruption to be cured without sort of paying down half the capital of the loan, I think is something that we have certainly been considering. I think interestingly, I'm not sure how much of that has yet translated into the letting market. So I'm not sure whether landlords are yet considering, well, should we have some slightly greater rent deposits, even from institutional names, to try to buffer for this effect happening in future. Long income investors in assets, I'm sure weren't expecting there to be non-payment of rent for very long-term secure institutional covenants. So I think that having a quarter of rent, or having a quarter of interest or something sitting in standby, is perhaps something that might become a feature going forward. I'd like it to be. Whether that will be the case or not is another matter. Sure.
It will depend a bit on the asset class.
Sorry, Alexandra, please go ahead.
Sorry, it would obviously depend a bit on the asset class, right? Because we've seen, like, and that's actually a very good point, right? On the more volatile asset classes, this makes a lot of sense. We really need it like on a residential portfolio.
Thank you. Sorry, I'm mindful, unfortunately, of the clock ticking out my right peripheral. And just trying to draw a couple things together before we close and thank the panel. But just coming back to you, Adam, one of the questions that's come up also has to do with repurposing. And a lot of repurposing that's being discussed is from whatever it is now to residential. And I was just wondering, from your perspective, are you seeing a lot of demand for the Greystars of this world to get involved in these types of repurposing to residential? And are you seeing that there's an appetite in the market to fund these types of arrangements?
I think you're certainly right. There's a lot of a lot of talk of it, and a lot of kind of movement in that direction. I think for Greystar as a company, it's not something we really explore that actively. Our product tends to be purpose built, purpose designed, heavily amenitized, which is frankly just difficult to reconfigure existing products to fit. So I think it's it's obviously a trend. There's obviously planning directions and pushes to make it happen. But from a Greystar side, it's not something that is a particularly active strategy or focus for us.
Well, we can talk later about this new business line I have in mind for you. But in the meantime, and with apologies that we didn't, although we had a great conversation, as ever, we didn't quite capture everything that we might wanted to have discussed. I wanted to thank the panel on behalf of all the viewers. Some 64 of them have stuck through to this time. I hope it's been an enjoyable discussion. I apologize for the questions that came through that we haven't had a chance to answer, but it's been delightful speaking with everybody today. And so on behalf of the silent viewers, I would just say thank you very much to the panel, and I look forward to the next discussion.
Thank you, everyone. It was a pleasure.
Thank you.
Thank you very much. Thank you.